This all comes back to commandment number 3. Follow my 10 commandments of successful investing, and you protect yourself from this. What is commandment number 3? Of course, you know. Thou shalt maintain control. Don't relinquish control of your money to a third party whenever possible. Invest directly. Be a direct investor. Whenever I'm not a direct investor, it seems like I always suffer this fate. You leave yourself susceptible to 3 major problems. Number 1, you might be investing with a crook. Number 2, you might be investing with an idiot, and they will lose your money because of their crookery or their incompetence. But number 3, assuming they're honest and competent, which is extremely rare, they take a huge management fee off the top for managing the deal. The person who sets up the deal is the one making all the money. The investors, if everything goes well, they're going to get, a modest return. But comparatively, the person running the deal, the promoter, the sponsor of the deal, is making an absolute fortune.
And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
The National Association of Realtors, Lawrence Yun, the chief economist who's been on the show twice, is out saying, don't expect a drop in home prices next year. He says we will see an increase in home prices of 1% on the national median home price. Now, NAR, I have certainly accused them of being a bit of a cheerleader for the housing market. And we are in a bit of a weird time where there seems to be a standoff between buyers and sellers, with both sides waiting for the other side to capitulate. And it will happen as a process. But the one thing we can say for sure is, what else are we going to do? And the one thing I have learned after decades, too many decades of being in this business, is money does not like to sit on the sidelines for too long. It wants to do something. It wants to deploy. It wants to invest. And I think we are going to see that happen pretty, well, I don't want to say dramatically, but in a pretty big way after the first of the year, after we get through the holiday season, which is a bit of a distortion because it doesn't, you just can't tell until you get into the new year to see what's going to happen, right? But we have this odd dichotomy in the marketplace, as I've explained before, and that is the difference in the resale market versus the new home market. Resale sellers having no real motivation to sell, by and large, because they've got these ultra cheap mortgages for the next 28 to 29 years, and they are not under any real financial distress. We've analyzed that up, down, sideways. But then we've got new home builders, and they have a whole different story. They don't have long-term fixed rate debt. They don't have income from their properties. Now, I don't know if you saw that JP Morgan Chase and it was a partnership, I can't remember the other big company, they have dedicated $1 billion to invest in the rental housing market, or over $1 billion, I believe. Don't have that in front of me. What's on the screen is this Lawrence Yun, National Association of Realtors article. But if this represents the smart money, they know better. And a lot of these builders, if they have properties that are in the lower price range, which mostly they don't, mostly their properties are in the middle to high-end price range. But for those few entry-level properties that they are building and selling, and of course entry-level is a moving target because the prices have gotten much higher because you can't build a cheap home anymore thanks to government regulation and environmental regulations and yada, yada, yada. If they have properties in the price range that will make any degree of sense in terms of a rent to value ratio perspective to rent out, either they, the builders, will turn those entire housing tracts or some portion of them into rental housing and basically be in the game of the institutional home builders. The thing that prevents them from doing that is being able to restructure debt from short-term construction debt to long-term debt that they can keep those rental properties for a while, or they will simply sell them to one of the many, many big institutional players in the single family home rental housing market now, because that market is underserved and underbuilt. But the apartment market for multifamily, it is overbuilt and now overserved. There was a shortage, but over the past several years, of course, we've seen lots and lots of 4 and 5 story apartment complexes going up on every piece of vacant land in every American city. And I'm sure the same is true around the world too. And so the multifamily is oversupplied. So if you are a multifamily investor, be cautious. If you're investing in any kind of multifamily deals, I think long-term, the trend is good. The demographics coming at the rental housing market are fantastic. You're okay, but they are briefly a bit overbuilt. Okay, so just understand that. Yet the single family home market is the opposite. They are undersupplied and underbuilt by a wide, wide margin. Lawrence Yun says, well, elevated mortgage rates, sluggish home sales, yada, yada, we all know that, right? In fact, we may see further uptick in home prices in 2023, even as mortgage rates stay at or near 7%. Yoon, who analyzed the current state of the residential market, offered his 2023 market outlook at the NAR conference in Orlando. Quote, for most parts of the country, home prices are holding steady since available inventory is extremely low, said Yoon. Some places are experiencing price gains, while some places, most notably California, are seeing prices pull back. Now, this is exactly as I predicted years ago, that the cyclical markets, California, and you could just keep going up the West Coast, the expensive northeastern markets, South Florida, where I live, those markets are going to see pain because those properties are too expensive. They are cyclical. They rose too quickly, too high. They're way out of whack with fundamentals. And the Case-Shiller Home Price Index is largely weighted to those types of markets. 75% of the Case-Shiller Index is cyclical markets. Only 25% are linear markets that we would recommend investing in. So that's why the data, you've really got to peel back the layers to understand what's really going on. And we've got significant inventory shortages. We saw inventory decline over the last week. We know that. And anyway, that's what we'll see, okay? So some forecasts expect home sales to fall in 2023, including Goldman Sachs, whose economists expect home prices to fall by 5 to 10%. Now, they may well be right, because overall, most of the data is skewed toward the cyclical markets, and those prices are falling, no question about it. There needs to be an index. Maybe the Hartman Comparison Index should do this, but we don't have the resources. We don't have the staff to do this, okay, folks? But it's a good idea. Dedicated toward linear markets, toward inexpensive housing markets with good rental properties, with good rent-to-value ratios. Those aren't falling at all. Those have inventory shortages that are significant and will take many, many, many years to clear. We have to do a lot of catching up to provide enough inventory for the demand in that segment of the market. So again, all real estate is local, but it's not just local. It needs to be segmented by housing style. What is it, multifamily or single family? It needs to be segmented by price range, by, of course, geography, linear, cyclical, hybrid markets, et cetera, et cetera. There are many ways to segment the market, and that's the thing we all have to really realize. Okay, so, you just can't get away from the news of all of these incredible scandals going on in the world of Wall Street and the world of crypto. So Elizabeth Holmes, the Theranos criminal, was sentenced to 11 years in prison. And really, you got to think, is that all? I mean, she ruined lives. She ruined many people's lives. And then, of course, we've got Sam Bankman-Fried, right? The complete crypto scumbag. You had to know all of this was too good to be true, folks, whose fraud may end up being bigger than Enron. And of course, he's protected by all of these left-wing Democrat politicians that he's donated millions and millions and millions of dollars to. So it's just completely ridiculous. I mean, look at the New York Times story about him, that even after the disaster, that story they ran, it was like they were completely protecting him, the disgusting criminals at the New York Times. I mean, just the article's not even critical. And here he's defrauded all of these people. It's just insanity, folks. But this all comes back to commandment number 3. Follow my 10 commandments of successful investing, and you protect yourself from this. What is commandment number 3? Of course, you know. Thou shalt maintain control. Don't relinquish control of your money to a third party whenever possible. Invest directly. Be a direct investor. Whenever I'm not a direct investor, it seems like I always suffer this fate. You leave yourself susceptible to 3 major problems. Number 1, you might be investing with a crook. Number 2, you might be investing with an idiot, and they will lose your money because of their crookery or their incompetence. But number 3, assuming they're honest and competent, which is extremely rare, they take a huge management fee off the top for managing the deal. The person who sets up the deal is the one making all the money. You know, the investors, if everything goes well, they're going to get, a modest return. But comparatively, the person running the deal, the promoter, the sponsor of the deal, is making an absolute fortune from that deal. And they're running all sorts of expenses through it. Sam Bankman, SBF, what did he do? I saw an article about this, and forgive me, I can't remember the number, but it's insane. I think he loaned $1 billion to himself out of the fund. He made a loan to himself for like $1 billion or some ridiculous amount of money like that. It's just absolute insanity, folks. I know it takes more attention. I know it takes more work, but to whatever degree possible, be a direct investor. All right. And also join us in Scottsdale. And by the way, we've got some Black Friday specials on tickets coming up. They're going to be very, very good. Look in your email box. Reach out to us at jasonhartman.com. Make sure you're on the list and you get the discounts, because we got some great ticket promotions coming up for Black Friday. And go to empoweredinvestor.com/live, empoweredinvestor.com/live for your tickets for our Scottsdale event at the end of January. It's going to be an awesome event. It's just shaping up so nicely. I was on the phone with Ken McElroy yesterday, and we were talking about it. Of course, he's one of our many great speakers there, and it's just going to be an awesome event. So Scottsdale, empoweredinvestor.com/live. And our main topic today is a presentation that I did that cost a lot of money for people to see, but you get it for free. Isn't that great? So you get it free here. I did this presentation for Ron Legrand's group. Ron has me come in and speak at his meetings very often, and this one was virtual. So I did a presentation about my thoughts and predictions on the market. And again, you've got to remember to segment this stuff. When I'm talking about it, I'm talking about entry-level rental housing. I'm not talking about the broader market. You've got to just make those proper distinctions. Otherwise, you're going to have too many blind spots and miss too many opportunities. And the question we've always got to ask ourselves is, compared to what, right? What else are we going to do? Someone says to me, well, I'll just wait. I'll just keep my money in the bank. Okay, well, great. You're going to lose 9% a year officially on your money through to inflation. And, most of us would agree that the real rate of inflation is 15 to 17%. And so if you have $1 million and you're just letting it sit in cash, you're losing $90,000 to $170,000 per year. If you have $100,000, you're losing $9,000 to $17,000 per year. Whereas with the income property, you're going to make money. And even if you don't, even if you break even, at least you're not going to lose. And sometimes, sadly, that is the strategy, the defensive strategy, the playing not to lose versus the playing to win strategy. But hey, come to Scottsdale. We'll talk a lot more about this and many other topics. And here is my presentation with Ron Legrand.